doesn't start with a crash. It starts with a rally. Stocks are up. Headlines feel calm. Everyone exhales. And underneath that calm, the same quiet mechanism clicks back on. Again, here's why this matters right now. When markets feel stable, nobody looks under the hood. But the last few times this pattern showed up, the damage was already done before the panic arrived. By the time people noticed, the exits were crowded. The story always begins the same way. Money gets cheap for a long time. Not free, just easy enough to feel normal. Businesses borrow, governments borrow, investors borrow. Not because they're reckless, because the system rewards it. Debt quietly piles up. Then rates rise. Not overnight, slowly, politely. At first, nothing breaks. That's the dangerous part, because most debt doesn't reset immediately. It waits. Think of the economy like a massive apartment building where almost every lease expires at different times. For years, tenants signed cheap leases. Now those leases are expiring, and the new rent is much higher. That's the mechanism most people miss. It's not today's interest rate that matters. It's the refinancing calendar. Every year, trillions in loans roll over. Corporate debt, real estate debt, government debt. Each rollover locks in today's higher cost. Even if rates stop rising, the damage keeps spreading as old debt gets replaced with new, more expensive debt. That's the uncomfortable math. A company that paid 3% now pays 7%. A project that barely worked before no longer works at all. So what do markets do? They celebrate the pause. The hype says rates are peaking. The reality says the bill is arriving. There's a quiet irony here. Financial stress doesn't peak when rates peak. It peaks later, when refinancing does. That lag is where things crack. Cash flow tightens. Defaults don't explode, they creep. Layoffs start small. Lending standards quietly harden. Banks don't panic. They just say no more often. And suddenly the economy feels sticky, heavy, unresponsive. Zoom out and the risk isn't one bad company or one bad sector. It's synchronization. Too many borrowers refinancing at once, at higher rates, in a slower economy. That's when the system stops bending and starts snapping. And here's the part nobody likes to say out loud. Markets can look fine right up until the moment they aren't. So the question isn't whether something is happening again. It's whether this time the lag runs out before the optimism does.